What's going to happen if the stock market does have a crash or a sell-off? Where are investors going to put that money? In Vegas, our housing market has been going insane. Super hot. Low inventory mixed with high demand mixed with incredible rates for the buyers. So if even if the stock market doesn't have a sell-off, we're still going to be busy and need to be able to cater to investors and understand the language that an investor speaks. If the stock market goes, where are they going to put that money? Someone isn't able to pull the returns they've been pulling in the stock market, they're going, or get cold feet, a novice investor, they're going to pull that money and want to put it towards something more secure and stable, which would be real estate. Now, in real estate, there's cap rate. Cap rate measures for an investor basically the amount of return they'll get on their investment. What percentage can they expect back? So all you do to measure cap rate is take the net operating income, divide it by your purchase price, and then that equals your percentage of cap rate. Average out here that you want to stay above is 7, especially if you have a note on the property, because you got to be able to cover your mortgage plus any expenses, plus for it to be an actual investment that is recurring. Now, what's awesome about real estate is for the long-term hold is you don't just make the money on the long-term hold cap rate, which is off your rental income, but you also have the ability to make the profit from the appreciation. So when you do your net operating income, to calculate it out, you take your net rent, so say $1,000 a month, that'd be $12,000 a year, or your gross rent. Then you minus out insurance. So say in Vegas, $1,000 for homeowners insurance with tenant. HOA, so if it's $50 a month HOA, you're going to minus out $600 for the whole HOA. You minus out the property tax. We're 0.875 of 1% property tax, so easy number just off the bat is just take 1%. So if you buy it for $200,000 minus $2,000, property management fees, whatever percentage you're paying for that, and then you take your total rent and you minus all those expenses that are no matter what hard cost, and say your net amount was $10,000. Well, if your net amount's $10,000 and you're purchasing a $100,000 building or property, then your cap rate would be 10%, respectively. If it's $200,000, it would be 5%. So the goal would be to get around that 7. If you're buying like one-off properties, it's going to be difficult to find right now because of the inventory, but rents are rising. So if you can do pro forma and see if things increase the same way, are you going to get to that? If you're buying more than one property, so are investors that buy in bulk or multiple properties at the same time, or in a project like a multifamily project, then it's different. You can get between 5 and 6% because you have vacancy rate then, with if one's out, another one's being rented. When you're a single off property, it's a lot different. But so cap rate, net operating income divided by purchase price equals your cap rate. And then a cool little trick, if you want to know how do you take that cap rate and see how many years it'll take you to make your investment back, just divide it by 72. It's called the rule of 72. So 10 into 72 would be 7.2 years. So if you're getting 10%, it'll take 7.2 years to make the crossover, and you're completely liquid, minus your holding cost of taxes, HOA a year. All right, that's my little cap rate overview. Hope you guys are having a good one. Dominate now in real estate. Please share, like, and comment, and I look forward to seeing you guys again.